All right. Hello, everyone. Thank you for joining our webinar today for year-end tax strategies. I can't believe it's November. I'm going ahead, all right, switch and introduce myself as well as Alan, who is our tax partner. So my name is Adrienne Davis. I am a certified public accountant as well as certified financial planner here at Zenith. And I'm really excited to talk about year-end tax strategies with Alan. A little bit of my background: started my career in tax, public accounting, then transitioned over to financial planning. So really excited to talk today. All right, Alan, I'll kick it over to you.
Thanks, Adrienne. Good afternoon, everybody. My name is Alan Elder. I am a licensed tax professional over here at Guardian Financial Services. Been doing what I've been doing over the past 7 years, and I'll talk about my experience as well as Guardian's experience in a second. But definitely looking forward to this and having this conversation and hosting this with Zenith. So, thank you guys for joining.
Yeah, perfect. Okay. All right. So I'll speak about Zenith first. I know we have some clients on here and some people who are not clients, and I wanted to talk about our company and what we do. So we are a minority-owned financial planning as well as investment management firm. We don't sell any products. We don't receive any commissions. Our clients do work with us because we are fee only and our advice is tailored based on paying a fee for service. So we do comprehensive financial planning, investment advice, and we have a variety of packages. We have a flexible as well as a team-based financial planning approach. Yeah.
All right. So here at Guardian Financial Services, just a little overview about the company. We've been in business. Oh, can you guys mute yourselves? Thank you. Guardian has been operating over the past 30 years. Was founded by Terrell Garrison, and we do a wide range of tax preparation and accounting services. We even offer business consultation, advisement, and credit repair. Like Zenith, we're a minority-owned CPA firm, and we specialize specifically in clients who have small businesses, real estate, and other various investments. But we can still help the individual tax preparers as well, if you do not have those things. And in addition to tax preparation, we offer tax planning, and it gives our clients the ability to meet with us throughout the year, whether it's quarterly or monthly, to go over the various different things that occur over the year, whether it's related to their business or investments and other things like that, so that they can properly plan on what to do to help them before tax filing season. So that's pretty much it. We go to the next slide.
Okay. All right. To kick things off, Alan and I have planned to have 45 minutes, give or take, for the presentation, and we wanted to leave about 15 minutes at the end for Q&A. So if you all have questions as we go along, feel free to leave them in the chat, and then we'll address them at the end of the presentation. Okay. All right, Alan, floor is yours.
All right, so I'll start things off. A lot of people hear about deductions and credits, but there is a difference between the two. Deductions, from a macro level, I'll give you an overview. Deductions decreases your taxable income, right? So it's not a dollar for dollar decrease in your tax bill, but it just decreases your taxable income. Credits, on the other hand, does decrease your tax bill or can potentially increase your refund, right? Once your tax bill is established based on your tax refund, whatever credits you have can knock down your tax bill. And obviously both things can help you, right? Now there's two ways that you can take deductions. There's the standard deduction, which is a specific dollar amount. As we state here, right now for 2023 is $13,850. And that's eligible to be taken by pretty much any taxpayer when you file your return. Once you have your total earnings established, you can take the standard deduction. However, so let me show you how that works. So if let's say your earnings are $50,850 and you're taking the standard deduction, your taxable income is going to be $37,850, right? And your tax bill is established from there. However, itemized deductions allows you to deduct more given several circumstances. So itemized deductions consist of mortgage interest that you pay, mortgage insurance premiums, charitable contributions, state and local taxes, and even medical expenses. And if those 5 things are hot, equate to be higher than 13,850, then you can deduct more from your earnings, right? So let's say those total things come out to be $20,000, right? So your total earnings, going back to my example, was $50,850. If you itemize your deductions at 20,000, your taxable income will be 30,850, right? So that's great. On the other side, credits, like I said, it's a dollar for dollar credit that knocks down your tax bill. And those credits can consist of the earned income credit, the clean vehicle tax credit, and the education credit. And we'll get to all of those things later on in the slide.
Yeah. And then to add, I guess why this is important and why we decided to kick things off with this is because when we're looking at the tax return, a lot of times people will say, like, for the itemized deductions, how do charitable contributions, how does the amount I pay in property taxes, mortgage interest actually affect my tax return? And if you are making charitable contributions at the end of the year, it is simply reducing what your taxable income is, and you don't get that dollar for dollar deduction. So, Alan, if you were to talk to a client and they said, which is better, what would you tell them?
Itemized is definitely better.
Okay.
And that's why I encourage my clients to buy property, to make charitable contributions throughout the year, but especially at the end of the year at a time like this, because obviously it can help decrease your taxable income.
Yeah. Okay. Thank you. All right. And then this is my slide. So planning for individuals and creating a tax strategy. So first thing we think about is, what are your various sources of income? Are you a W-2 employee? Do you receive 1099 income? Do you have a mixture of both? Are you a business owner? And that's important because you're able to typically have additional expenses that you're able to deduct as opposed to when you're a W-2 employee. Do you have investment income? Typically, investment income such as qualified dividends and capital gains are taxed at a different threshold than your income. And then also RSUs and stock options. So those typically vest and affect your taxable income because it's ghost income in a sense. RSUs, when they vest, even if you do not sell them, you still have to pay the taxes on them. So when we're thinking about creating a tax strategy, we need to identify where your sources of income, because that will allow us to understand what can we do from a planning perspective. And then when we think about that, we just mentioned the standard deduction versus the itemized deductions. Do our clients own property? But with the Tax Cuts and Jobs Act that happened a few years ago, they increased the standard deduction so that less people will be able to take it. They also put a cap on state and local taxes. So the amount of income taxes you pay, the amount of property taxes you pay, if they're more than 10,000, you actually cannot deduct them. So this does impact a lot of our clients when it comes to the itemized deductions, because you're just not automatically placed in that category. We mentioned charitable donations. A lot of times we need to see, does it actually make sense? A lot of our clients are charitably inclined, but when we think about it, are you going to put yourself over that threshold to get to the itemized deduction? If not, then maybe we can game plan and put money elsewhere. And then we also have out-of-pocket medical expenses. But I would say I rarely see people able to deduct this because it has to be 7.5% or more of your adjusted gross income. So what that means is your taxable income, well, not your taxable income, but rather the money that you make from all your various sources. And then you have your various deductions is at 7.5%. So even if I were to say 100,000 as an example of your adjusted gross income, and then we say 7.5% of that is 7,500. Did you have more than 7,500 in medical expenses? Then you're able to deduct it. So you could see why it's probably not as common for us to see that. And then state and local taxes, I did mention that along with the property taxes as being that 10,000 cap. So a lot of times we look at standard versus itemized is one way that you can do proactive tax planning to see, all right, what are you on track for and what adjustments do you need to make, as well as those various sources of income. Okay.
All right. So for those that have children, right, there are various credits and deductions that apply to you, right? And this is for folks that are married with kids or just folks that are head of household filing single. And yes, thank you for your questions. We do we will open it up for questions at the end of our presentation, and so we'll definitely answer anything that's in the chat or that's asked at that time. But getting back to sorry, back to the slide.
Sorry. Sorry, Alan.
No, you're
Okay.
fine. You're fine. Getting back to the credits. So obviously the child tax credit applies to folks with children, and that credit is a maximum of $2,000 per child, right? So if you have two children, you can take the total credit of $4,000. Pretty self-explanatory. As long as the child qualifies as a dependent and has lived with you throughout the year, you can take that credit. The child care credit also applies. That's dependent on various factors, but the total maximum for that is $4,000. And like I said, it depends on how much you're paying in child care, the age of the child, and also how much you make as a taxpayer as well, where you're at in your tax bracket. And then the earned income credit is a credit that folks can earn. Is a credit that folks can take if they earn income, usually around $50,000 or less. So if you're a business owner and you didn't have that great of a year, you can take the earned income credit, especially if you have children, right? And those thresholds are, if you don't have children, 16,000, but if you do, the next threshold for one child is 43,000. The one after that is 49,000. And then if you have three or more children, the threshold is 53,000. So like I said, if you make less than 53,000 of earned income and you have children, you can definitely take the earned income credit. And then as far as deductions for folks with children, if you have a college savings investment plan, and you're making contributions to that plan throughout the year, or have made a contribution to that plan throughout the year, you can deduct that contribution from your taxable income on the state level. So when you do your state return, right, you can deduct those contributions there. So let's say your income is at 100,000, right? And you made $2,000 in contributions to the college savings investment plan, you'll be taxed on the state level at 98,000. Or whatever income that you claim on the federal return, you can deduct more than that on the state level. So and then obviously student loan interest deduction, as long as you are below the $85,000 threshold, you can take deductions on the interest that you paid on your student loans. And also any IRA or retirement contributions can be deducted as well from your taxes.
Yeah. And then for the states, I did want to call out that it really does vary. I've seen Pennsylvania, for example, if you're a couple and you are filing jointly and you have one beneficiary, you can deduct up to $34,000 on the state return. And I would say that's very robust as opposed to a state like Maryland, where it's lower, or even a state like Texas, where they don't even have the deduction, but also they don't have the state tax. So yeah. Okay.
Yeah.
We also wanted to call out the IRA contributions, because for couples who may do married filing separately, there are additional rules and implications that you do have to consider. So typically running a projection for a couple to say, all right, does this make sense for us to file married filing separately? And various reasons, student loans, public service loan forgiveness, not wanting to inflate your income from that perspective, those are other considerations you'll have to make as well. Okay. All right.
So, sorry, this is my slide as well. I apologize. So love talking about this for business owners, right? This goes back to the tax planning that I was referring to at the beginning of the presentation, right? So you want to make sure you're planning throughout the year, especially if you're a business owner. You don't want to just talk to your tax preparer once a year when it's time to file taxes, right? You want to make sure you're keeping track of, whether it's your bookkeeper or yourself, of your earnings throughout the year. Where's your revenue at? Where's your expenses at? Where are your profits at, right? Because that's going to affect your taxes. That's going to affect your tax situation, your taxable income, your tax bracket. So you want to make sure if things jump, if things are higher than where they were the year before, you're talking to a tax planner to help you do the things necessary to get your tax bill down, increasing some deductions or some expenses for you, so that you're not bearing a big tax bill that you're not willing to pay, or that you're uncomfortable with paying, and all that stuff, or just being prepared for that situation. And I'll get into how you can structure your business in order to prepare as well later on. But like I said, you want to keep track of your earnings. You want to make sure you keep track of your investment income. You can talk to your financial planner or whoever's running your account to see, how much your stocks are growing or how well they're doing throughout the year. If you have stock options that you acquired throughout that year or RSUs and all that stuff, that can also affect your taxable income, paying capital gains and all that stuff. So if you are a business owner, right, a lot of the things that can kind of offset higher earnings are some of the deductions we have over here on the right, right? Taking the home office expense through your business, right? A lot of people are unfamiliar with this because, their business isn't related to them being at home, or, their business is on a computer and they can kind of run it from anywhere. But if you have a house, or if you rent your house, you can take the home office deduction, whether it's the simplified method or the other method. You can also write off your car, right? If you use your car for your business, or if you use your car to get from point A to B when you're making business transactions, doing promotion, advertising, you can write off your car. You can write off the expenses for your car. And then if you own the car, you can also depreciate the vehicle as well. A lot of people don't know that as well through the actual expenses deduction from the business. And also, obviously owning property helps you a ton when you're a business owner. One, for the home office expense, but also you can deduct a portion of your home through the home office expense, or depreciate it rather, a portion of your home through the home office expense. And obviously, if your business involves rental property, you can depreciate the entire house, right? Because the entire house is used for business at 100%, basically, when you're renting it out. You can also write off the repairs that you make to the home, the mortgage that you pay, HOA fees, utility bills, etc. So you definitely just want to plan as a business owner so that, come tax filing time, you're looking at your 1099s, you see 50,000 or 100,000 and, like, oh, what am I going to do? You definitely want to make sure that you keep track of everything so that nothing comes as a surprise, or that you're, getting the proper advice from a tax planner so that they can help you lower your taxable income. So.
And Alan, what about estimated tax payments for your business owners? I know that differs from the W-2 employees.
Yes, definitely encourage my business owners, if they can, to make estimated payments quarterly throughout the year. And if you're set up as a corporation and you're doing payroll and you're writing yourself a salary, which I'll get into, you can also make payments there as well. When you do your payroll taxes, you can send in extra payments. But yes, making estimated payments surely helps you for sure. If you can afford it, it's definitely encouraged. And really, if you know that you're going to report some profit, the IRS, more than encourages you to make estimated payments. And sometimes they penalize you if you don't. So definitely make sure you're making estimated payments throughout the year, especially if you can and you're doing really well. So yeah, thank you.
Yeah. And I guess I'll try to explain it in a way that makes sense that I was taught, where if you're a W-2 employee, you know that you get paid and you get your paycheck and the taxes are taken out every paycheck. So the IRS is really keen on making sure that, yes, they get their income as well as they get any interest that's tied to it. So if you make money all year and you haven't paid them, the IRS is saying this is actually a problem because we were supposed to be getting our money throughout the year. So that's really how they try to do it with the penalties and the additional fees. Okay. All right. So now we'll pivot into the key considerations that we wanted to talk about for tax planning before year end. And I'll kick things off because it's open enrollment season. And I actually, Sarah will probably appreciate that. I'll do a shout out. I have a video and a blog coming out soon about open enrollment. And this is something we've been helping our clients with because there are a lot of tax plays within the open enrollment realm. The first thing is retirement contributions. So when you get paid and you have a salary, typically you're able to take deductions on them so that you're not taxed on that income. Pre-tax retirement contributions allow you to reduce your taxable income while benefiting you for the future because you are putting money to the side to grow, invest for retirement. Also, if you have access to a high deductible healthcare plan or an HSA, HSAs have triple tax benefits. We really do like them for our clients, especially if they're willing to take on more risk or are relatively healthy. This is not a one size fits all for everyone. This is something that we have to have conversations with our clients about. For me personally, I am risk averse when it comes to my health. So if I have access to a high deductible healthcare plan and HSA, if I have access to a PPO, I likely would do the PPO and then not take those additional tax benefits, right? Then we have the FSAs. So FSAs are eligible for people who have, for example, a PPO plan. We have dependent care FSAs as well for families who may have kids or are caregivers and they want to reduce their taxable income. So this is another way that you can maximize your benefits through your employer. HSAs, you can keep them as however long you want. You can put the money in there this year and not touch it until you are 85 years old, and it could be growing that time. FSAs are use it or lose it. So although it may be appealing to reduce your taxable income, if you are actually not using that money, then you would actually be wasting your money. So we always talk about that with FSAs, like, all right, you're putting $3,000 towards this healthcare FSA. Did you actually have $3,000 in healthcare expenses? You're like, oh, well, no, because my employer pays for, my health insurance, my deductible is like $100 or $1,000 a year. So I actually don't use it. So then that's when the FSA may not be advantageous. And then commuter costs also for our clients who are not remote employees. Do you have to commute to work? Do you pay for parking? Is this something where you can reduce your taxable income? You're going to need to use the money anyway, but this is an additional tax play. All right, so when we think about our clients who are W-2 employees, we do talk about the various accounts and the benefits of them. Now, we will send this slide out and we have it recorded, so I won't go through each individual box. But one thing to note is that the limits are actually changing for next year. So if you, for example, have your 401k on set it and forget it, make sure you're maximizing it, that you're maximizing that at $23,000 a year next year. Same thing for the Roth 401k. Traditional 401ks, these are the pre-tax benefits, so you reduce your taxable income. The Roth 401k, you do not reduce your taxable your taxable income. However, people like the Roth because you pay the taxes now, it grows, and then you don't pay them later in retirement. We'll talk about this a bit more on another slide as well. The brokerage account does not have any benefits when it comes to, for example, open enrollment or immediate tax benefits. However, if you have a brokerage account, you have investments, you hold on to them for more than 1 year, you do have that capital gains tax rate that is dependent on which tax bracket you're in, but the maximum is 20%, as opposed to, so 20% for someone who's in a 37% tax bracket for their income. This is why investments are optimal, because you aren't paying as much in taxes. And then also I mentioned the HSA with the triple tax benefits. Okay.
All right. So now I'll talk about charitable contributions and how they work, and some things that folks may not know about when it comes to charitable contributions. So whenever you're making a charitable contribution and you want to deduct it from your taxable income, it has to go to a qualified organization. And a qualified organization is any organization that was granted the tax exempt status from the IRS. So typically nonprofits, that includes churches, community outreach organizations, whether they're local or nationally, Greek organizations that people are a part of when they pay dues, or any other organization like that. Those are qualified organizations that you can contribute to. A lot of people don't know this, but when you volunteer for these organizations, whether you're a member of them or not, you can write off the mileage that you use to get to the event, where you volunteered at. You can write off any parking fees that you pay while you volunteered. If you pay for any uniforms or supplies in order to volunteer for that particular event, you can write those contributions off as contributions as well. If you donate to a donor advised fund, right, and pretty much a donor advised fund is a charitable investment account that supports charitable organizations, right? So if you donate to those funds, you can obviously, write that off as well. And if you somehow set up a donor advised fund and you're contributing and all that stuff, obviously you can write that off. And then one other part that you can write off as a charitable contribution are appreciated long-term capital property. And what that is any stock or property that you've owned, that you had for a year and a day, if you make donations or if you donate stock to a qualified organization, you can be able to, write that contribution off without having to pay for the capital gains that those stocks or that property has gained you. So for example, let's say you had some stocks throughout the year that did really well. And let's say you're looking at your stocks right now, like, man, I did really well this year. I don't want to pay the capital gains on these stocks. You can find an organization that you can donate those stocks to. And if they're a 501c3 or nonprofit, they can certainly, if they want to, accept those donations of stocks and investments. And you can avoid paying the capital gains on them. And you can write off the contribution that you made as well. So various different ways you can contribute to charitable organizations, and these are some of them. So next slide. Or Adrienne, do you have anything to add?
Oh yeah, for the donor advised fund, I wanted to give an example of a client who had a lot of income this year, and they were like, all right, well, I want to donate to a charitable organization, but I don't actually know which one yet. So if you open a donor advised fund, put the money in there for the year, you can hold it and choose which organizations you want to donate to at another time. So you get the tax benefit this year, but then you're able to choose and take your time with the donations at a later time. Yeah, that's the only thing I wanted to mention though. Okay.
Thank you.
All right. Oh, and this is my slide. So tax loss harvesting. So with the stock market, we saw last year that the stock market wasn't doing as well. This year it was doing well, and now it started to actually not do as well. So tax loss harvesting is important because of the capital gains that you typically have. So if you're in mutual funds, for example, you may have capital gain distributions. If you sell stock through the year, you know that your income may be inflated. So what we typically try to do is reduce your taxable income and take losses on maybe those investments that you have that haven't been doing as well. And what happens is, say you have 20,000 in capital gains, you can reduce that with 20,000 in capital losses, and then you end up having to break even at zero. However, if you do not have any taxable capital gains throughout the year, say you had a loss of 10,000, you can only take up to 3,000 in the year, and then the rest have to be carried forward. And then we also have wash sale rules, which typically are implemented because what a wash sale means is, if you say I have Apple stock and then I sell it for a loss, but then within 5 days I buy some more. Hello? Then all right. Then I'm not actually able to take that loss. So tax loss harvesting is advantageous because you're able to take advantage of the volatile stock markets, reduce any capital gain distributions, but this is something that you would likely do with your investment advisor, ask them about, because it is different. So if you look at your investment account and you say, this is my cost basis versus the fair market value of what it's worth today, did you actually have any realized gains? AKA, did you sell anything throughout the year? That's how you determine if you had any capital gains. And you can typically find this on any month end, quarter end, year end statement. However, as we're thinking about planning for the end of the year, capital gain distributions a lot of times are made at the end of the year. So that's something that you'll have to look out for a lot of times in December, so that you aren't hit with that ghost income that you don't actually see. It doesn't hit your bank account. It stays in your investment account. Yeah. Yep.
And one last thing I want to add to that. Sorry, Adrienne. Especially over the last couple of years with the stock market not being as great. Definitely encourage you to talk to your financial planner, obviously, when making a decision on whether to sell stocks and all that stuff. But from a tax perspective, a lot of my clients have been benefiting from how poor the stock market has been, quote unquote, because they've been able to take those losses when they file their taxes, which reduces their taxable income. So, definitely, just because the stock market isn't doing as great doesn't mean you should sell or, get rid of your stocks and all that stuff. Definitely talk to a tax planner to see how it could help you, especially relevant to all the other earnings that you have, other investments or business and all that stuff, because that can definitely help you when you file your taxes claiming that loss. So that's it.
Okay, thanks, Alan. And then also Roth conversion. So for example, Maybe your income was higher last year than this year, and you're in a lower tax bracket. This could be a prime opportunity for you to have some of your pre-tax 401k, IRAs rolled and converted into a Roth. What happens is that you are moving from an account or holdings where you have to pay taxes for it later, which we don't know what the tax rates will be in the next 30 years, right? So this allows you to plan ahead, as well as when you have pre-tax retirement holdings, you typically have required minimum distributions once you hit a certain age. So what this means is, like, right now, it's about 72 years old. Once you hit 72, you have to start selling those investments and pulling that income out of your investment accounts. Why? Because the IRS wants their money. That's really the only reason why. So not the only reason, but the IRS wants their money. They're like, you've been holding on to this. And what happens when people pass away is they get a step up in basis. So if someone was 72 years old and they're like, yes, I don't have to sell RMDs, and they hold that and then they pass it on, they pass away, someone will get their investments and they don't have to pay the taxes on the difference because of that step up in basis. You can also withdraw the contributions tax-free for the Roth, and that's why people like it. If you had 100,000 and you took it out of a pre-tax account, you would have to pay the taxes. And a lot of people know this if they've taken withdrawals from a IRA or a 401k, typically withhold 20% in taxes, and then you may get hit with 10% in penalties if you aren't at the age of retirement. With the Roth, if you are in retirement, you don't have to withhold those taxes. And then typically there aren't any income restrictions. So. Alan, did you have anything to add?
Nope, you pretty much hit everything.
Okay, perfect.
All right, so one of my favorite topics to discuss is business structure. I mentioned this earlier. Business structure can mean a lot from a tax preparation, tax planning standpoint. And how you structure your business can really save you thousands and thousands of dollars in taxes, right? So everybody's heard of an LLC, right, for the most part. But you can also structure your business into a corporation, whether it's an S Corp, which is a smaller corporation, or a C Corp, which is a larger corporation, right? Anytime you have an LLC or even a partnership, right, you have to file your business return, and the shareholders, whether it's one shareholder or multiple shareholders, pay the taxes on that profit through on their personal tax return. So everybody receives a K1, right? And then whatever is on that K1, you have to pay income taxes on it. But you also have to pay self-employment taxes on it. And self-employment taxes is pretty much Social Security and Medicare taxes, right? You know, because you have a business, that income that you're reporting isn't being paid through a job where they can withhold Social Security taxes, Medicare taxes, and other things, right? So when you file the return and you file that income, you have to pay taxes on it. And when you're just an LLC or a partnership, you have to pay self-employment taxes, and that's double. You pay it as an employer and an employee, right? But if you structure your business into a S corporation or C corporation, you give yourself the ability to write yourself a salary as an officer, right? And then what that does, when you write yourself a salary, you end up paying those self-employment taxes once as an employee, because now you're an employee of the business as an officer. And you know, by doing that, you can avoid paying double in the self-employment taxes. And that self-employment taxes for LLCs or sole proprietorships or partnerships is like roughly around 12%, in addition to the income taxes that you're already going to be paying on that same income, right? So definitely talk to your tax planner and tax advisor on, you know, the benefits of being a corporation, the benefits of writing yourself a salary. When you do that, obviously you got to pay payroll taxes throughout the year, and file those payroll taxes and all that stuff. So, you know, you're probably going to have to pay your accountant or your tax preparer a little bit more to do all that stuff for you. But, you know, paying an extra maybe couple thousand to do all that stuff will save you $10,000, $15,000, depending on whatever profit you're reporting. So definitely how you structure your business will save you money. And then just going into the business donations, whether you're LLC or an S Corp, you know, you can write off the donations that you make from your business to whatever tax exempt organization is out there, and you can deduct 100% of those donations, as opposed to just 50% typically when you're just an individual, right? So business donations can definitely help you. If you are sole proprietorship, whether LLC or corporation, you can set up a solo 401k. Our friends over at Zenith can help you set that up. And the contributions that you make to that 401k, that solo 401k, can be deducted from your income, your taxable income as well. So how you structure your business means a lot. I always tell people to start a business because it gives you a lot of flexibilities when it comes to the tax law and all that stuff. When you just have a job, or if you have investments, those numbers are what they are. You withheld what you withheld throughout the year. Your investments, you can't really handle yourself in terms of like dictate the outcome, right? Setting up your business, having a business, and then setting up the business structure is a way that can help you from a tax planning and tax saving standpoint. So,
yeah, I love that you said that, Alan, because that is so true. If someone's like, all right, I don't want to pay taxes, but it's like, if this is your W-2 and this is whatever income that you got from your investments, that's what your tax transcript shows. That is what your tax situation will be. But if you are on the business side, yes, they may see, all right, you have this 1099 income or whatever income you're reporting. However, the expenses are really on you to basically report. And then the IRS, if you do get audited, they have to say, all right, are you able to substantiate these expenses that you have? That's why great record keeping is very important when you are a business owner. It's not just a matter of, okay, I'm going on vacation and I talked about my business. You actually have to document it. And I know Alan talks about this with his clients a lot of times, making sure that you're documenting when it comes to your business expenses.
correct. And one additional thing, sorry, when you write yourself a salary, a lot of times the business ends up reporting a loss, right? Because that salary is counted towards expenses. So that's the last nugget I wanted to add. I'm sorry I didn't mention that before, but that's something that's really important because you're going to be reporting losses instead of gains. And obviously you don't pay taxes on losses. So like I said, business and business structure gives you a lot of flexibilities as a taxpayer.
Okay. All right. And then Alan mentioned the different retirement accounts that you can have as a business owner, and we wanted to call out a few. The SEP IRA, the solo 401k, they're implementing a new thing where you can have a Roth solo 401k and even an HSA. So a lot of business owners, if you have your own healthcare plan in the marketplace and it's a high deductible plan, you can actually open up an HSA or you're on your own and have those triple tax benefits that we mentioned, where you're able to reduce your taxable income. It grows in the market tax free. And then if you take the money out and use it for medical expenses, you don't have to pay taxes. So that's why people really do like the HSA, especially because if you're in the marketplace, the premiums for the health insurance policies are pretty expensive anyway. And then for the SEP IRA, well, I'll mention the solo 401k first. So typically this is if you are the sole owner of the business. So if you have contractors who work for you, you can have a solo 401k. However, if you have employees, this is not feasible. That's when you'll want to look at the SEP IRA or even a simple IRA, which we don't have on the slide. But essentially, the solo 401k gives you more flexibility and allows you to do employee contributions in addition to employer contributions, where the SEP IRA typically is employer contributions. So there are various limits. The contributions are changing again from 2023 to 2024, and there are income limitations as well. But we really do encourage our business owners who have excess cash to put money into retirement accounts because it's benefiting them in the long term, and you see taxable benefits right now.
Yep.
Okay. All right, so that concludes our presentation. I know we're about to do Q&A. I did want to call out, we have a financial fitness quiz. So if you want to use this QR code in order to do that, but we also have Alan's email if you're interested in reaching out to him for tax planning. We have Zenith's email as well. And then we are also including the Instagrams if you would like to follow us as well. Okay. Yep. All right, so we'll go to questions, which this slide, but I'll leave it on this one since so we have the QR code. But I know, Alan, there was one in the chat already for you.
Yeah, so I'll read it out aloud for everybody. So it was asked, for Alan as a service, do you also review previous year's tax filings for corrections? It was my first year filing jointly, unexpected. equity, new business income, etc. I'm not totally confident we took advantage of everything. Yes, we do review previous year tax returns, and after we review it, we definitely meet with you to give our recommendations for changes if we do have any, and then we can also obviously execute those changes via an amendment and all that stuff. So yes, I do offer that service. Any other questions?
Was anything not covered that anyone wanted to talk about?
I have a question. This is Ashley Lane.
Hey, Ashley.
Hi, Adrienne. Hi, Alan. Alan, you mentioned that if you're a business owner, you recommend that the owner touch bases with you probably like quarterly or at least twice a year. Do you recommend the same for W-2 employees or people that just have simple LLCs for like real estate investments?
Yeah, sure. It may not be as an extensive conversation, but sure, I do recommend that. There's a chance that, for whatever reason, you changed your exemptions or contributions or whatever throughout the year. So it doesn't hurt for me to take a look at your, pay stubs, from the past month or whatever to make sure you're still on track with everything in terms of paying taxes. Sometimes if you have if you have rental properties or real estate business, things change throughout the year. That's a business pretty much. So yeah, I do recommend that for sure. Maybe not, on a monthly basis, but, definitely we can check in quarterly just to make sure, you're on the right track. And, if I have any suggestions for you, I can give them and you can execute them.
All right, we have another question. I guess, Alan, you can answer this if you would like. What are the most common mistakes you see from self-filing versus working with a professional?
I think the most common mistakes are just the deductions that apply to you don't always get applied. When you're working with a tax professional, this is what they do. At least I speak for myself. This is what I do on a daily basis, right? I'll have a lot of clients, have a lot of different situations. And so I'm able to, know from my own experience and my education of what applies to a specific taxpayer, right? In terms of deductions, expenses. Sometimes you can file the right numbers, they're filed on the wrong forms, right? And all that stuff. Also, because of my experience in clients getting audited and handling those audits, I know what the IRS is looking for in terms of audits, right? And so the limitations in terms of what you're writing off and expenses and all that stuff to stay off the IRS's radar is something that is beneficial as well. But also with me, like I said at the beginning of this, like I'm not just preparing your taxes. I do offer tax planning with my clients. So when I do your taxes and we have our meeting to discuss like, what you owe or what your refund is, I give my recommendations from there. So, if you're filing as yourself, obviously you're not receiving those recommendations, right, for the next year or for years coming, in terms of a business or what could help you and all that stuff. So I think those are the main differences. But like I said, I encourage those, especially those who have more than just a W-2 to definitely have a tax professional do their taxes, because it's what we do on a daily basis. And there's not much we're going to miss when it comes to your own situation. So,
yeah.
Sorry. Go ahead. No, I was just going to say, an extra couple $100 can save you thousands of dollars. That's what I always tell clients. And I see it every week. Folks are apprehensive about paying for services and all that stuff. But you could really save yourself thousands of dollars in terms of your tax bill, refunds, whatever, by working with a professional. So
yeah, I was going to say maybe even, Alan, just having the knowledge of various credits that you mentioned, right? The child tax credit, earned income, or I don't even think we talked about it, but education credits. If someone is taking additional classes, they may say, oh, it's the American one, and then the American Opportunity Credit and the Lifetime Learning Credit. If you've already maximized the American Opportunity Credit, you can still use the Lifetime Learning Credit if you are taking classes at a community college to expand, if you're going to a master's program. So that's something I typically would see as well.
Absolutely.
Yeah.
Yep. Any more questions?
It's me again, Ashley. I have one more question.
Mhm.
Is there ever a benefit to be married and then filed separately? Like, is it more advantageous to file jointly?
From a macro level, it's definitely more advantageous to file jointly.
Okay.
There's certain deductions and credits that you won't be able to apply to your situation if you file separately. But there are situations where it's beneficial to file separately. If before you guys got married, one client, one spouse rather, owed the IRS a ton of money, right? And they're withholding their refunds that they get every year because they owe that balance. If you file separately, the other spouse can continue to receive whatever refunds they receive when you do that, right? If a certain spouse had a really bad year from a business perspective, or a really good year rather, and they have a really, really high tax bill because they did well, the other person didn't, then that could be a reason to file separately too. But I would advise that you have your tax professional look at that to make sure that that's actually true. And it may cost you a little bit more to figure that out, because for me, in order for me to figure that out, I have to do the separate returns, right? And then I got to do it jointly. Those are like 3 different returns that you have to do to figure out if it's beneficial. But for the most part, it's beneficial to file jointly, because there are various deductions and credits that you won't receive if you file separately.
Yeah, I wanted to even call out the itemized deduction. So say there's a couple and they're married and they do married filing separately. If one couple does itemized deductions to take advantage of the mortgage interest, property taxes, all that stuff, the other spouse must file itemized as well. Their itemized deductions may only be $3,000, but they won't be able to take that standard deduction, which is what did you say, the 13,000? So they're losing out on 10,000 of deductions for that reason.
Correct.
All right. Is there an income amount you would recommend that a business switch from an LLC to an S corporation?
Yeah, I would say there's a profit. So it's after all expenses. I would say if your profits are anywhere between, I would say 75,000 or more, then I would definitely recommend doing that. And like I said, that's profits, that's after expenses. So let's say, your business did revenue at 100,000 and your expenses are 25, and that's what you're reporting. Then I would recommend, once you enter that 75,000 a year range, that you convert and write yourself a salary, because it'll be worth you doing the payroll taxes and all of that stuff at that point, because once you enter that realm, like I said, once you get to 100,000 in profit, self-employment taxes is 12%. That's about an additional 12,000 more on top of the taxes that you're already going to pay for that income. That's going to be added to your bill. And so, I definitely would say, like, in between, once you get over 75,000, I definitely encourage you to do that. But obviously, talk to your tax planner, tax preparer, to get some more advice on that. But generally, I would say about 75,000.
Right. If you are working 2 jobs, is it advised to make estimated tax payments? So if you are working 2 W-2 jobs and they are withholding federal income taxes from both jobs, then there is no additional need to make estimated tax payments. And your 2 jobs are not communicating with each other. They're only communicating with the IRS. So your other job will likely not know that you have these additional taxes paid. And then you'll probably also be over contributing to your your Social Security and Medicare taxes as well. So you may get an additional refund, because the Social Security limit is like 160. So if you are paying it from both jobs, then you'll probably be over contributing.
Yeah.
Now,
go ahead, Adrienne. Go ahead. Sorry, I thought you were done. Go ahead.
Okay, I was going to say, if one is a full-time W-2 job and the other is a 1099 contract position, then estimated tax payments for that additional 1099 income may make sense depending on how much it is. So that's really a case by case, depending on the threshold. Because if that 1099 position has about 10,000 income coming in, there's no need to make estimated tax payments. But if you're making 200,000, then absolutely the IRS would say you have been under withholding potentially throughout the year. But Alan, what were you going to say?
Yeah, sorry. So on the W-4 form, when you first start at your job, they ask you on there, what was it, W-9? I'm sorry, I always get them confused. They ask, yeah, so they ask you on there, do you have other income that you plan on making at like another job, right? And you want to make sure you say yes there, because that affects how much they withhold. And so, yeah, like Adrienne said, if you get additional taxes withheld, you might be overdoing it. But also, depending on how much more income you're going to be making from that second job, it can move you into another tax bracket. So you want to make sure on that form that you indicate that you're getting more money, that you're going to earn more money, and indicate how much it will be, so that the right amount of taxes are taken out. In addition to that, I keep saying this, I would advise you reaching out to whoever your tax planner is, tax preparer, and ask them what you should indicate on that form based on your situation, so that the right amount of taxes being taken out throughout the year. And like I said, it all depends on how much money you're making in total from both jobs. But you definitely want to indicate on that form that you're going to be having more income. You're going to be earning more income, throughout the year, and make sure that the taxes are correct.
And then for the HSA contributions, as far as are they cumulative? So the HSA contribution limit is for the year. So for 2024, it's going to be for an individual 4,150. So essentially, your job will ask you, hey, do you want to max this out? And they'll calculate how much you need to contribute every month in order to max that out. If your employer gives you an HSA contribution, say they give you a flat match of $1,000, then you would have to reduce the amount that you can put into your HSA by that contribution. So the amount that you can put into the year is set at that 4,150. I'll compare that to a 401k, how the limit next year will be 23,000. Your employer can match up to that 66,000 number. So you can put in the 23,000, your employer will match it, and you don't have to reduce your contributions for any match as long as it's underneath that threshold. Okay. What would you suggest looking for or asking when searching for a tax professional?
So what I suggest is obviously someone that is knowledgeable, right, about all the tax laws and the different deductions and credits and all those things that would apply to any given situation, not just yours, right? But also, you definitely want a tax professional to have the reputation of looking out for the best interests of their client, regardless of the situation, regardless of how much money they're going to make from that transaction or what they have to gain. It's all about the client first, right? We're in a service-based business, and you're dealing with folks, IRS tax returns and all that stuff. You definitely want to make sure you're working with somebody that has integrity and that is looking out for what's best for you, but also is knowledgeable. Someone that communicates, someone that has some foresight and can give you some advice about what to do moving forward as it relates to taxes, as it relates to your business and all of that stuff. That's what you should look for, in my opinion.
And then I'll add to that licenses, certifications. So for example, if you go look up Alan, he is a licensed practitioner with the IRS. Guardian is a CPA firm. And then other things is does that tax professional work with people in your similar situation? Of course, if you have knowledge, we can always do our research, but if you are a business owner and you speak with a person and they're like, yeah, I've never done a business return, likely that tax professional wouldn't be aligned and the best fit for you. Same thing for even a lot of our clients have equity compensation. If your tax person does not have expert experience with that, they can miss some big things. We've seen some accountants where they would double report the equity because it was double counted. So as a financial planner, Chelsea actually did this, called about 40,000 that the client was reporting as income. No, it was more than that. It was more income. It was a 40,000 refund they got. So by having a tax professional who can look at this and see your specific situation, I would say that's advantageous. All right. When should a young professional think about having a financial planner and consider having a tax expert? Alan, I can answer that, or you could.
I think anytime you have a job, and you're looking to build for the future, you're looking to buckle down on like how much you spend and savings and investments and all that stuff, you should definitely at least seek the counsel of a financial planner. And then like once your quote unquote portfolio, everything else becomes like robust and you're doing well from a business standpoint after you're starting off, then I would definitely seek the services of a financial planner to help you grow everything that you have and manage it properly. And then I'm sorry, that's the second part of that question is consider having a tax expert. I think you should have a tax expert if you have investments, if you have a business, businesses, and you're making money, you're earning money, or you have the goals of earning money and all that stuff, and you want some advice. I would definitely seek a tax expert once you get to that point for sure. Once you, like I said, have a business and investments, you want to make sure you comply with the IRS every year and you're filing everything correctly. So.
All right. And then the last question, if you volunteer, are you able to write off mileage and other expenses when volunteering?
That is correct. And the mileage rate you can write off is like 14 cents a mile. But yes, if you're traveling to volunteering events, every mile that you use traveling to and from that volunteering event, you can write off the mileage at 14 cents a mile. And like I said, other supplies that you buy that you're not getting reimbursed for and all that stuff, uniforms, can be written off as well.
So is this for business owners or individuals? And is this on the Schedule A or is it on the Schedule C or the business return?
Oh, good question. So if you're just an individual, then it goes on the Schedule A, itemized deductions. But if you're a business owner, it goes on the Schedule C. And then obviously if you're a partnership or that's corporation, C corporation, that goes on the 1065 and the 1120S. So, but yeah, like I said, I think if you have a business, I definitely recommend as much as you can making donations on behalf of the business, because you can write more of it off. But obviously, if you don't have a business, you can still write it off. It just go on the Schedule A, and it won't be as much. So.
Okay. All right. So I know we said that was the last question. Did we want to take down your information, Justice, and respond to that offline? Or Alan, did you want to take it now? I know we are at time.
I can, because the answer to this question is definitely robust. I definitely will take this offline. If you want to email me, Justice, I can definitely answer that question for you. Because I know, like I said, we are running out of time. But if you want to email me, my email is right here on this page. Or you can, contact the Instagram page. I can definitely help you with that.
Okay. All right. Well, thank you everyone for showing up and being engaging, asking questions. And if you have any additional questions for us after this, feel free to reach out to us. Our information is right here. Alan's is right there. So yeah, have a great rest of your day.
Thank you, everybody. Have a good one.